Welcome to a complete English masterclass on national accounting. This video is a unified treatment of 8 separate Hebrew lectures by Michael Raviv, rebuilt as one coherent English course. We will cover everything from how GDP is measured, to the sources and uses identity, to capital formation, to the various income concepts, to real versus nominal output, to the state budget, and finishing with 2 worked exercises that pull everything together. Each section stands on its own. If you want to study one specific topic, you can jump directly to it. But for the full picture, watching the entire video in order will give you a deep understanding of how national accounting actually works. Let's begin. Section 1. The basic question we begin with is, how do we actually measure GDP? There are 3 theoretically equivalent approaches: the expenditure approach, the income approach, and the production or value-added approach. Each one looks at the economy from a different angle, but all 3 produce the same number because of how the accounting works. The expenditure approach asks, who spent what? The income approach asks, who earned what? The production approach asks, what was actually produced and how much value was added at each stage. Let's focus on the expenditure approach, the most commonly taught and the most intuitive. Output, denoted Y, equals consumption C, plus investment I, plus government spending G, plus net exports, exports X minus imports M, Y equals C plus I plus G plus X minus M. This is the core identity. Every dollar of output is bought by someone, somewhere, by households, by firms investing in new capital, by the government, or by foreigners. Every dollar produced must be a dollar spent. There is nowhere else for it to go. The income approach reaches the same number by tracking all the income generated: wages, profits, rents, interest. Every dollar of value created becomes someone's income. And the production approach sums up value added at each stage of the supply chain. The 3 numbers must match by construction. Differences in practice arise from measurement errors, statistical discrepancies, and timing, but in theory, they are identical. The expenditure approach gives us the most useful diagnostic. We can see how much of GDP comes from consumption, how much from investment, how much from government, how much from net trade. Section 2. The Sources and Uses Report. This is one of the foundational tables in national accounting, and once you understand it, everything else falls into place. The sources side lists where total resources available to the economy come from. There are exactly 2 sources: domestic production, Y, and imports, M. That's it. Anything available to spend or save in the economy must come either from what was produced at home or from what was bought from abroad. On the uses side, we list what those resources are used for: consumption C, investment I, government spending G, exports X. The fundamental identity of national accounting is sources equal uses. Y plus M equals C plus I plus G plus X. Rearranging, we get Y equals C plus I plus G plus X minus M, which is exactly the expenditure GDP identity from Section 1. This is the same equation viewed from 2 different angles. The sources and uses table makes clear that imports and exports are not just trade flows. They are accounting items that balance the books between what an economy produces, what it acquires from abroad, and what it consumes or invests or sells. Understanding the sources and uses identity is the foundation of all open economy macroeconomic analysis. You cannot evaluate fiscal policy, monetary policy, or exchange rate policy without thinking through how these identities adjust. Section 3. Capital formation. The investment component of GDP, usually denoted I, is not a single homogeneous category. It is composed of several distinct types of capital formation, and understanding the distinction matters for analyzing economic dynamics. The first component is gross fixed capital formation. This includes new buildings, new equipment, new vehicles, new infrastructure, everything that physically extends the productive capacity of the economy. The second component is changes in inventories, the net addition to stocks of unsold goods held by firms. Inventory accumulation is real production that has not yet been consumed. Inventory drawdown is consumption from past production. The third component, sometimes added separately, is acquisitions less disposals of valuables, gold, art, jewelry held as a store of value. Each of these components moves with different economic forces. Gross fixed capital formation responds to interest rates and expected demand. Inventory changes are highly procyclical. Firms accumulate inventories when demand is strong and run them down when demand weakens. Now, gross capital formation includes depreciation. Net capital formation equals gross capital formation minus depreciation, minus the wearing out of existing capital. Over time, the capital stock evolves according to net investment. If gross investment exceeds depreciation, the capital stock grows. If gross investment is less than depreciation, the capital stock shrinks. An economy is actually losing productive capacity. This was, for example, the situation in much of post-Soviet Eastern Europe in the early 1990s. The investment report, the breakdown of how much capital formation comes from each source, is one of the most important diagnostic tools in national accounts. Section 4. From GDP to disposable income. GDP is not what households can actually spend. There are several steps that transform total output into the income households have available for consumption or saving. The journey begins with GDP at market prices. Subtract depreciation, and you get net domestic product. From net domestic product, add net factor income from abroad, the income earned by domestic residents from foreign assets, minus the income earned by foreigners from domestic assets. This gives gross national income, or GNI. Then we move from national income to personal income. Personal income equals national income minus corporate retained earnings, profits firms keep for reinvestment, minus Social Security contributions, plus transfer payments, pensions, unemployment benefits, welfare. The final step. Personal income minus personal taxes equals personal disposable income, the actual money households have to consume or save. The disposable income concept is what we use when we build a consumption function. C equals C0 plus C1 times Y disposable. This is the operational definition. The distinction between GDP, GNI, national income, personal income, and disposable income matters because each measures something different. GDP measures production. GNI measures national income. Personal disposable income measures household purchasing power. For policy analysis, the right measure depends on the question being asked. For productivity studies, you want GDP. For welfare comparisons, you want disposable income per capita. Section 5. Real versus nominal GDP and growth rates. Suppose nominal GDP rose from 1 trillion to 1.1 trillion this year. A 10% increase. Is the country actually producing 10% more goods and services? Maybe. Maybe not. If prices also rose by 10%, then production didn't grow at all. Only the price tag did. To separate real growth from inflation, we need to compute real GDP, output valued at constant prices. Pick a base year. Value all output at base year prices. The result is real GDP. The ratio of nominal GDP to real GDP is called the GDP deflator, the broadest measure of inflation in the economy. The percentage change in real GDP is the real growth rate of the economy, the number that matters for living standards. The percentage change in nominal GDP is the sum of real growth plus inflation. Now an important refinement. Real GDP per capita. Divide real GDP by the population. This is the standard measure for comparing living standards across countries and over time. A country with a growing GDP but an even faster growing population is becoming poorer per person, despite the impressive aggregate numbers. China grew at 10% per year for decades, but its per capita growth was a bit lower because population was also growing. India faces a similar issue today. For welfare comparisons, real GDP per capita is what we want, not raw GDP. The calculation is straightforward. Take nominal GDP divide by the deflator. Divide by population. The result tells you how much each person in the economy actually earned, in inflation-adjusted terms. Section 6. The state budget. Government accounting follows similar principles to national accounting, but with its own structure. On the revenue side, the government collects money from several sources. Tax revenues are the largest, including income taxes, corporate taxes, value-added tax or sales tax, property tax, customs duties, and various excise taxes. In a typical developed economy, total tax revenue is around 30 to 40% of GDP. Beyond taxes, the government also has non-tax revenue, fees, fines, dividends from state-owned enterprises, royalties from natural resources. On the spending side, the government has several major categories. Government consumption G, wages of public employees, purchases of goods and services for public administration, schools, healthcare. Government investment, building roads, bridges, military equipment. Transfer payments, pensions, unemployment benefits, welfare programs. And interest payments on the national debt. The difference between total spending and total revenue is the budget deficit, if positive, or surplus, if negative. Deficit equals spending minus revenue. A persistent deficit accumulates into national debt. There are two important refinements. The primary deficit excludes interest payments. It measures whether the government's non-debt activities are paying for themselves. The structural deficit adjusts for the business cycle. It measures what the deficit would be in a normal economic year. Both are important diagnostics. The Maastricht criteria of the European Union restrict deficits to 3% of GDP and debt to 60% of GDP, limits chosen to prevent debt sustainability crises. The state budget is therefore not just a fiscal statement, but a major piece of macroeconomic policy. Section 7. A worked exercise on the sources and uses identity. Let's apply the theory. Suppose an economy has the following data. Domestic production, Y equals 1,000. Consumption, C equals 700. Investment, I equals 150. Government spending, G equals 200. Exports, X equals 100. We want to find imports, M. The sources and uses identity says Y plus M equals C plus I plus G plus X. Plugging in, 1,000 plus M equals 700 plus 150 plus 200 plus 100. The right-hand side equals 1,150. So 1,000 plus M equals 1,150. Therefore, M equals 150. The economy imported 150 units of goods. We can also compute the trade balance. Net exports equals X minus M, which is 100 minus 150, equals negative 50. The economy has a trade deficit of 50. As a check, we can rederive GDP from the expenditure side. Y equals C plus I plus G plus X minus M. Y equals 700 plus 150 plus 200 plus 100 minus 150. Y equals 1,000. This matches our original number. The accounting closes. Section 8. A comprehensive exercise, closed economy. Assume a closed economy, no exports, no imports. The fundamental identity becomes Y equals C plus I plus G. Suppose the marginal propensity to consume is 0.8, autonomous consumption is 200, investment is 300, and government spending is 400. We want to find the equilibrium GDP set Y equals C plus I plus G. Substitute the consumption function C equals 200 plus 0.8 times Y. We get Y equals 200 plus 0.8, Y plus 300 plus 400. Collect terms. Y minus 0.8, Y equals 900. 0.2, Y equals 900. Y equals 4,500. So equilibrium GDP is 4,500. The Keynesian multiplier here is 1 over 0.2, which is 5. Each unit of autonomous expenditure produces 5 units of equilibrium output. Now suppose the government announces an additional spending of 100. Delta G equals 100. The multiplier predicts delta Y equals 100 times 5, which is 500. New Y equals 4,500 plus 500, which is 5,000. Let's verify. C equals 200 plus 0.8 times 5,000 equals 4,200. I equals 300. G equals 4 plus 1, which is 500. C plus I plus G equals 4,200 plus 300 plus 500 equals 5,000. Matches. The accounting closes again. The exercise shows two things. First, the closed economy multiplier of 1 over 1 minus MPC, which is 1 over MPS. Second, that real arithmetic from the consumption function and the expenditure identity perfectly aligns with the multiplier result. This is the foundation of all Keynesian fiscal analysis. Conclusion. We have walked through 8 topics. Output measurement methods. The sources and uses identity. Capital formation. From GDP to disposable income. Real versus nominal. The state budget. And 2 worked exercises. Each one is a fundamental piece of macroeconomic accounting. Together, they form the conceptual foundation that every modern macro analysis builds on. If you find this kind of comprehensive course useful, please share this video with someone who would benefit. And subscribe to Macroeconomics with Michael for more deep dives into the foundational ideas of modern macroeconomic theory. Thank you for watching all 8 sections.